What if the very tools you were told would build your future are the same ones quietly taking it away? What if your mortgage, the proud symbol of security and success, was actually a financial time bomb? And what if your credit card, that sleek piece of plastic promising freedom, was designed not to help you, but to keep you dependent forever? We've been told the story of progress. Work hard, buy a home, manage your credit, and life will reward you. But behind that story lies a much older, much darker truth. A truth written in the fine print of financial systems that were never built to serve the average person. Today, we're uncovering the hidden architecture of two of the most powerful inventions in modern finance: mortgages and credit cards. We'll trace how they rose, how they broke, how they trapped millions, and how, even now, their logic continues to shape your financial life. Because until you understand how these traps were built, you'll never know when you've already stepped into one. Let's start with the image we've all grown up with. Owning a home is the ultimate goal. Having a credit card means financial maturity. And debt, we're told, is not a burden, it's a tool. But here's the twist. Every tool can be turned into a weapon depending on who's holding it. The word mortgage literally comes from Old French, mort gage, meaning dead pledge. Even in its origin, the language hinted at what it truly was: a pledge that only ends in death or full repayment. The idea sounds noble: borrowed to buy a home, pay over time, and one day it's yours. But few people realize that what looks like ownership is often just long-term tenancy from the bank. For the first 10 to 15 years, the majority of your payments go toward interest, not ownership. You don't own the house. The bank does. You're just paying rent at interest.
Credit cards were born from a simple promise: convenience. Buy now, pay later. Travel lighter, live smarter. But as history would soon show, convenience has a cost, and it's measured in billions. Today, Americans owe over $1.2 trillion in credit card debt, according to the Federal Reserve, and the average interest rate, over 21%, the highest in decades. That means for every $1,000 you owe, you're paying the bank more than $200 a year just to stand still. So how did we get here? How did tools for empowerment become systems of control? To answer that, we have to go back, way back, to where it all began. After World War II, millions of returning soldiers needed homes. The US government responded with something revolutionary: the GI Bill and FHA loans. Banks were encouraged to lend, the government would backstop the risk. The result? The rise of the suburban dream. White picket fences, 2 cars in the driveway, a family smiling on the lawn. The 30-year mortgage became the golden ticket to middle-class life. But there was a catch. As mortgages expanded, banks learned something powerful. The longer people stay in debt, the more profitable the system becomes. So instead of short-term loans, they pushed for longer ones. 10 years became 20, 20 became 30, and soon 40-year loans began to appear in global markets. Every extra year meant more interest, more dependency, more profit. The American dream wasn't just a cultural myth, it was a financial product. And the same logic soon spread worldwide. Meanwhile, a new idea was taking shape that would redefine personal finance entirely: the credit card.
In the 1950s, in California, a man at a restaurant called Long Island's Diners Club forgot his wallet and realized there must be a better way to pay. From that accident, the credit card was born. At first, it was an exclusive luxury. Members of the Diners Club could eat on credit and pay later. But as technology advanced and as banks sought new profit streams, the idea scaled. By the 1980s, with deregulation sweeping across the US and UK, credit cards became mainstream. Marketing campaigns exploded. Don't leave home without it. What's in your wallet? Buy now, pay later. And so began the golden age of consumer credit. But something else changed too. Interest rates, which once hovered in the single digits, began to skyrocket. Banks discovered that revolving debt, people carrying balances month after month, was far more profitable than customers who paid on time. So the incentives flipped. The less responsible you were with your credit, the more money they made. By the 1990s and early 2000s, both systems, mortgages and credit cards, had merged into a single ecosystem of debt. Mortgage-backed securities turned your home loan into a tradable commodity. Credit card debt was bundled, securitized, and sold to investors as consumer asset-backed securities. Your personal financial struggle became someone else's profit stream. You weren't just a borrower, you were a product.
Every swipe of your card, every monthly payment, every refinance was another data point in the system. The logic was simple. Keep people spending, keep them borrowing, keep them paying interest forever. And the messaging was everywhere. Don't rent, own. Your home is your best investment. Use your card and earn points, cashback, miles. Behind the slogans was a psychological operation. When we feel like we're winning, earning rewards, building equity, we don't see the slow drain underneath. In 2006, US household debt reached a historic high of $12.68 trillion, with over 70% of it tied to mortgages. Everyone thought they were getting richer, but in reality, they were simply leveraged to the hilt. Then came the shock. In 2007, cracks started to appear. Mortgages that had been handed out like candy, many to borrowers who couldn't afford them, began to default. The system was built on the assumption that housing prices would always go up. But when they didn't, the entire structure began to implode. Banks failed, millions lost their homes, global markets collapsed. The safe instrument, the mortgage, was suddenly toxic. The very foundation of modern finance turned to quicksand. Meanwhile, as the housing bubble burst, consumers turned to their last line of credit cards.
Credit card debt spiked. Defaults followed. By 2009, over 15 million Americans were in serious credit card delinquency. The banks responded not with forgiveness, but with new fees, higher rates, and lower credit limits. The trap had closed. Government stepped in. Bailouts were issued. Regulations tightened. For a while. But the deeper problem wasn't fixed. The system didn't collapse because of a few bad loans. It collapsed because debt itself had become the engine of the economy. When growth depends on borrowing and profit depends on people staying in debt, recovery can only ever be temporary. Fast forward to today. Interest rates are rising again. Household debt is breaking new records. Credit card delinquency rates are the highest in over a decade. The trap never went away. It just changed form. Now it's packaged as buy now, pay later, zero down, low APR, or refinance to save more. The names change. The mechanism doesn't. Because debt, when normalized, becomes invisible. And invisible systems are the hardest to escape. You might wonder, how do smart, rational people keep falling for the same tricks? The answer isn't ignorance. It's design.
Financial systems exploit human psychology. We fear missing out more than we fear losing money. We prefer small rewards now over larger rewards later. If everyone else has a mortgage or a credit card, it must be safe. Banks know this. They've studied it for decades. That's why credit cards offer free points instead of debt. That's why mortgage ads show smiling families, not amortization tables. They're not selling products. They're selling identity. And identity is the hardest thing to give up. Look at some hard numbers from 2025. $12.9 trillion in mortgage debt, $1.21 trillion in credit card debt. Over half of American households carry month-to-month balances. The average cardholder pays more than $1,400 in interest annually. People are spending more than ever just to maintain the illusion of stability. Governments have tried. New rules, better disclosures, financial literacy programs, but none of it touches the root. You can't fix a system that's working exactly as designed. The mortgage market still depends on people taking on lifelong debt. The credit industry still depends on people revolving balances. The global economy still depends on consumption, fueled by credit. It's not broken, it's functioning, just not for you. Debt has gone digital. It's faster, quieter, and far harder to notice. So before you sign, swipe, or click, ask yourself, who benefits from this debt? If the answer isn't you, walk away. Because the first step to financial freedom is seeing the trap for what it really is.